Welcome to 228main.com. This is Katie Leibman, the Director of Communications, reading the best of the blog to you. If you are of a certain age and have certain retirement accounts, you probably need to know about the annually required withdrawals from those accounts. The IRS calls them required minimum distributions, or RMDs. One special note, clients, many of you are already treating your retirement accounts like an orchard, taking out the fruit crop each year to live on. The RMD is not an extra amount on top of that. It's just a minimum. If you're already taking out 5% in monthly payments to fund your retirement, you don't need to worry about what happens at age 73. So we'll talk about the details here and then how it works out in practice. People born in or before 1950 with any form of retirement account, other than a Roth, have already begun doing this RMD process each year, or should have. People born in 1951 or later will have to begin by the year they turn 73. The actual amount required is a function of age and the prior year-end balance. For example, a 73-year-old has to take out a little less than 3.8%. In round numbers, this would be $3,800 per $100,000 in the account. But that fraction goes up a little bit every year. 80-year-olds are closer to 5%. 90-year-olds have to take out more than 8%. Basically, the RMD needs to be calculated for each retirement account you have, except Roth IRAs. You must take out the total amount required by December 31st, and you will receive a 1099-R showing taxable income. Clients, you know that we pay attention to this and strive to keep you informed about what needs to be done. But there is one thing to be careful of. Take this as an opportunity to check whether there is some account somewhere that we don't know about, like a 401k from a former employer, an odd IRA balance somewhere, 457 or 403b plans, and so on. It happens, but it would be a pain to get yourself into some trouble over an account that's been out of sight, out of mind. Some people may choose to use the onset of RMDs as a time to consolidate all of their retirement funds into a single rollover IRA to make this process simpler going forward. One of the advantages of Roth IRAs is that they have no RMD requirement. As a matter of good planning, it may make some sense to convert partial IRA balances to Roth, pay tax when you choose, and whittle down that balance that's subject to the RMDs in traditional retirement accounts. There are lots of ways to handle things, so if you'd like to talk about it, we're here for it all. Email us or call. Disclosures. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. This information is not intended to be a substitute for specific individualized tax advice. We suggest that you discuss your specific tax issues with a qualified tax advisor. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to make a required minimum distribution, RMD, in the year you convert, you must do so before converting to a Roth IRA. For more content like this, subscribe to our weekly newsletter at 228main.com/newsletter. Until next time, stop by and see us at 228main.com, online or on Main.